family mode.
Hey, hello everybody. My name is Kiana Danial. To start please bear with me. Do a quick sound check. Type in a Y if you can hear me, if you have any troubles. Okay, I guess I needed to have my microphone problem. Louder. I'm trying to save my strength for the actual. Bear with me another 1 minute. Okay, it's 1 p.m. local time here in New York City. It is a snowy day. It's snowing like crazy all night. It's all white over here. I don't know where you guys are from. Please type in the city that you're from and tell us how it is in your area. It rarely happens that the weather actually affects the currency market, but sometimes it actually does. You know that when we have tragedies and tsunamis and hurricanes, it actually does affect the currency market and the currency of that specific country, whose currency is basically not being traded because people are stuck in traffic or under the snow or in tsunami, which is not actually that funny. So before we get into the webinar today, we're going to give a little bit of a time for all attendees to join in. In the meantime, I would like to talk a little bit about all the craziness that's been going on in the forex market, especially in the euro and the British pound crosses. What happened is that, well, with the British pound, as predicted, if you have been following our videos on Orbex, we have been saying that the British pound could go lower to the 152 level, and in fact is going lower. The reason for that is because Bank of England decided to keep their rates at record low. It's been 6 months. They are not changing it, and people are losing faith. So the British pound is going down, and the Bank of England actually has been keeping the rate, at 0.5%. And the panel also agreed to leave the size of BOE's bond portfolio unchanged. So that has been the reason why, if you have been following the British pound, that has been the reason why today we saw massive drops. And even more so, we've been seeing drops in euro, which is great for today because we actually saw this coming based on our continuation signals. So we are going today, we're going to go through confirmation and continuation signals and see how you can also forecast and predict the markets based on them. So that exactly did happen with euro-dollar pair. We identified a triangle, and the market actually continued lower than what it was before. But obviously, the fundamentals had to do with it as well. It was the ECB president who said that they will launch QE program on March 9th, which is less than a week from now, and pledged to buy sovereign bonds with negative yields up to minus 0.2%. And that is the reason why, well, especially today, fundamentally speaking, euro-dollar fell from a daily high of 1.11 to a low of 1.10. It's a decade low. Last time euro-dollar was this low was back in 2003. That is before I even started trading forex, which is crazy. But so this has actually, this could be a signal for even more drops towards the levels that we're going to talk about afterwards if we have time to go through a live market theory. So we have enough people, I'm hoping, today. It's 4 minutes past 1, and let's get started with today's agenda. We're going to have a quick introduction of Orbex, Investivo, what we do, why you're here, introduction of you, if you would honor us by actually chatting and texting us your opinions and your background over here. So feel free to interrupt us and tell us your story while we're doing this webinar. I always love to hear from our attendees. It makes me feel more closer to the attendees and makes me feel less as I'm just talking to myself and nobody's listening. Then we're going to do a quick forex market introduction and common terms for those of you who are joining us for the first time and are not familiar with the forex market. It's going to be very quick, so for those of you who are experts in the market, don't worry about it. And then we're going to focus on today's topic, which is continuation chart patterns, and we're going to cover all important ones in the forex market known to the technical analysts. And then we're going to hopefully have time to have a live market walkthrough to show you how you can set stops and limits and how even recent price actions can be traded based on continuation chart patterns. So get prepared, get your notebooks and pens ready in order to write down my words of wisdom. And definitely it's a better method than walking or checking your Facebook while listening to this webinar, because that way you'll just, you know, do everything not perfectly. I'd rather you be completely focused. As much as I know a lot of you guys love to go through your Twitter and Facebook accounts, I definitely recommend that you be alert and have your notepads ready and take notes and ask questions. This is a live webinar, and here we go. Let's do an introduction of Orbex Traders Library. I'm assuming you're here because you're already familiar with the brand name, with the name of Orbex. They're doing a great job in educating the trading crowd, and I definitely recommend that you check out their Traders Library. They have videos, ebooks, infographics, trading tips, analysis on a daily basis. Education videos were actually developed by myself, and they are great, very easy to understand for any beginner, and the analysis for anyone who is trying to get a sense of timely and live market sentiment. And next, a quick introduction of myself, why you should be listening to me, who am I? Am I even good enough to be telling you what to do? Well, I definitely, I don't know, but I'm going to be honest with you. I have been in this market for the past 6 years that I've been living in the U.S. Before that, I was just a regular college student. I was studying in Tokyo, Japan. I lived in Japan for 7 years. If you have any Japanese here in the house, please type in a Y and konnichiwa. But at the time, I wasn't even studying finance or economics. I was an electrical engineering student, and I didn't know anything about finance. Anybody here who doesn't know anything about finance here? Type in a Y for yes. Okay, so people know a little bit here about finance. I didn't know anything. But what happened is that in 2008, the market crashed. Major financial crisis happened. I was completely illiterate about it. I didn't even know what financial crisis means. And what happened though is that everywhere I went, I could hear that, oh, dollar is going down, US dollar is going down versus Japanese yen. I'm like, all right, I kind of can understand what is going on because I am a foreigner in Japan. I have accumulated a bunch of Japanese yen, and the US dollar is going down, and I'm planning to go to the US at some point. So if it is going down versus the Japanese yen, that probably means I should be buying US dollars now rather than later, right? So that's how I kind of got interested in the whole currency exchange thing. And then I became more interested as the market continued going down. And I was like, all right, maybe I should buy it. Maybe I should wait and buy US dollar when it reaches the lowest point versus the Japanese yen. I'm like, how am I going to know when it's going to be the lowest point? Maybe I should check my check the rates every day. And so I started checking the rates every day. And I was talking about it out of nowhere to my Japanese mom, who is also a forex trader. Great for our Women's Day campaign that I'm going to talk about in a bit, actually. And she told me that, in fact, if you trade your Japanese yen the way I'm going to teach you, you may be able to multiply your money by quite a bit of a margin. And I'm like, what are you talking about? And she told me what to do. And then, and next thing I know, I've put $10,000 in a forex account, and in less than a month, I doubled it. And you can imagine, as a college student, how excited I got to get $20,000 in my pocket just by putting it in a forex account, right? So that is the start of how I got into forex trading. And I got so excited about it that I actually moved to New York, which is a financial part of the whole world, and I continued in the forex market. I got educated, I got a lot of degrees in it, and I finally founded Investiva.com, where I educate women and men alike how to trade forex responsibly. And here I am today with you with Orbex, and we're going to have a great day. Let's go through the basics of the forex market. For those of you who are new, forex market is the largest market in the world, 53 times larger than the New York Stock Exchange itself. Very easy to trade. The reason why, comparing to stocks, are only 7 major currencies that are mostly traded, comparing to thousands and thousands of stocks. So the only things that you have to keep up with, if you're even a full-time trader, are 7 major countries, not all those companies and company portfolios. Another amazing advantage of the forex market is that it never stops until Friday afternoon in New York City, which is the New York trading session. It starts in Asian session, beginning of Asian session, that is Sunday night in the East Coast of the USA. So basically we have 6 days of trading nonstop, no 4 o'clock closing bell, and no 9 a.m. opening bell, which gives a lot of opportunity internationally. Even if you're working or sleeping or taking a bubble bath with a waterproof computer, you can trade. So these are amazing benefits of trading the forex market. However, we do have some risk involved with the forex market as well that we have covered in the past. I'm going to mention it again. That is the high leverage and high volatility that are very, very beneficial if you're in a winning trade, and very, very non-beneficial if you have made a mistake. So the whole idea behind our education is to learn how to manage our risk properly, how not to get into a losing trade, and if we do, how to get out of it without losing more than we can afford. Another interesting thing about the forex market is that it does move in cycles. It's safe to say that it doesn't crash the way that the stock market crashes, even though we have, for example, the dollar versus Swiss franc basically crashing or tanking or going really, really down very, very fast on January 15th in 2015. That was technically also not a complete crash because the Swiss, neither the American or the Swiss economy went bankrupt, it was just a very high volatility and high volume of trading. With companies, however, you always have the risk of the companies going bankrupt and you losing all the shares that you had in their stocks. So that is another advantage of trading forex. The markets normally move in cycles, especially in the long run. So you can always expect the market go back to where it was at least 10 years ago, and we are seeing that today in the euro-dollar pair. So how to make money in forex? Very easily. You make money on the way up, and also you make money on the way down. Two ways. I'm going to highlight it over here. So the market moves in zigzags, and every time it hits a bump, we call this line a resistance. Why we call it a resistance? Anybody knows? I didn't think so. The reason why we call it resistance is because the market is resistant from going further up. And of course, in the stock market, going up, an uptrend is always the best thing for a market. But with the forex market, actually, is not necessarily so. You can also make money on the way down. And when the market goes down and hits a barrier, we call that line or that level a support level. Why? Because that imaginary level is supporting the currency pair to fall further down. So we call that the support, we call this the resistance, and we're trying to make money at these points, right? And next, we talked a little bit about fundamentals of today's news at the beginning of this webinar, but what we're going to really focus on today is technical analysis, and within that, continuation patterns. So what is technical analysis? Am I going to get a hammer and like a plumbing technician over here? No, that is not it. A technical analysis or a technical analyst is a person who analyzes the markets based on the chart patterns. And the idea behind it is that the market behaves in the way that it has done before because history repeats itself. So what a lot of analysts over time, over years and years, have come up with are market psychology and the patterns that shows how the traders and the investors are behind these market movements, and how a retail trader, a person who's not within the financial industry, can identify these sentiments, identify these patterns, and make money based on that. Technical analysis is mostly done, especially recently, on candlestick charts because they are, the best method. I'm going to explain in a little bit. And what you need to know if this is the first time you're seeing a chart is that we have the price over here. The price is the pair. So here we have the euro-dollar pair. The prices are printed over here as the time goes by to the right. So this chart shows the euro-dollar prices snapshot of a long, long time ago when euro-dollar was in the 150 area. Today it's at the 110 area, so big difference. But at the time also we can see a lot of interesting movements that could have led us to knowing what is going to come afterwards. Quickly, we've done this before. Charts also come in other patterns if you're kind of getting confused. We do have candlestick charts that are my favorite, but originally we actually only had line charts which only showed the closing price of the market, and therefore they didn't show the market movements during the specific time period. Then we had the bar chart over here, which did show the market movement during this specific time period, let's say the 1 hour, but it wasn't user-friendly enough because the bar was too thin and the tips were too micro that if you didn't have a very big screen, you could have missed the market open, the market close prices. So a better option was actually the candlestick charts were developed by a Japanese rice trader back in the 1600s. Then it was transferred into charted market trading. Quick review of the candlestick charts. It is actually important because we're going to use this for our continuation patterns. A candlestick looks a lot like a candle. It has a body, which is like the body of the candle, and then we have these shadows coming up, which could be the wick of the candles, right? And the good thing about the candlesticks are that they're colored, and the colors are normally universal. The most common colors for candles are, for bullish candles, which means when the prices generally went up, are blue, green, or white in this case. And the common candlestick colors for bearish candles, which means when the prices generally went down during a specific time period. In the specific chart, we have the 4-hour chart, which means each candle took 4 hours for each of these candles to complete. And if in this specific time period the candlestick, the markets move down generally, that means that candlestick is bearish, the market was bearish, and therefore the color is black, red, or in our case, purple. You're going to see our charts later on. So that is the story behind the candles. You have the market open at this price. It goes over here all the way to the low. It goes all the way up, highs, and then it closes at this price. And therefore, we have a bullish candle. Similarly, for a bearish candle, we have the open market price. The price travels all the way to the highs, to the lows, and then comes back, closes at this price, therefore making a bearish candle. And these are the different time frames for candlesticks. Very important because when you take a look at the 30-minute chart at the same exact time, you'll see that it's quite a bit different than a 4-hour chart. The reason why for that is 4 of these 30-minute candlesticks make only one of this 4-hour candlestick $1. With me? And then 6 of these 4-hour candlesticks make up for one daily candle, right? Because it takes 1 day to make this little one over here, while it takes 4 hours to make this or this or this or this, and the combination of this make this one over here. Are running out of time actually. Let's go into continuation patterns. Are you ready? So continuation pattern, basically the idea behind it is that the trend is your friend. A lot of you guys have probably heard this before. Trend is your friend as the basic of every trader. Not always, but definitely today when we're talking about continuation pattern. And that continuation pattern is basically when, for example, let's say we're on an uptrend, everybody's going up, market is bullish, and then we hit a pause. This is when the opportunity for us to identify a continuation pattern which helps us to get out of the trade if we weren't already and make money in the coming uptrend up to here. So we are going to focus on this pause today, which we call the continuation patterns. The difference between reversal pattern and continuation patterns that we covered before in our previous webinars is that that pause that we saw after an uptrend during a reversal pattern, that was an indication that the market is actually going to reverse, as the name suggests, and is going to go against what it was going before. So the trend is really not your friend when you identify a reversal pattern. Today we're not going to focus on that. We're only going to focus on continuation patterns. So there are three main types of continuation patterns. Triangles, they have three other types within themselves. We have rectangles and we have wedges. And of course, while we have continuation patterns during an uptrend, we obviously have continuation patterns downtrend, which helps us forecast more down moves for the currency pair if we identify it correctly. So let's see how we do it. So the main thing that you need to understand about continuation pattern is that they definitely are very tricky. They are also called consolidation, that you may have heard of before. But if you mistake a confirmation or if they fool you with a false breakout, they can oftentimes turn out to be reversal. So obviously, comparing to, let's say, Ichimoku indicators or candlestick chart patterns or Fibonacci, continuation patterns are not as strong as a pattern, but they need to be watched very carefully because they oftentimes give us brilliant trading opportunities either way. So you basically, all you need to know is to identify the pattern, guess at the time if it's going to be continuation or reversal, back it up with other indicators, back it up with fundamental news, and then wait for a confirmation. That is how to trade a continuation pattern. Let's start with triangles. There are three types of triangles: symmetrical triangle, ascending triangle, and descending triangle. The names are self-explanatory. So a symmetrical triangle is where we have a zigzag over here, and if you basically, if you connect the dots of the lower highs and the higher lows, so this is our chart, this is our price, you're connecting all the dots of these zigzags, and you get this triangle, which looks pretty symmetrical, which means that it is centered, and both lines, one line is moving down, another line is moving up, and they meet in the middle. That is a symmetrical triangle. Next, we have an ascending triangle. That is when the upper line of the triangle is actually vertical, which means the market is trying to go up, but it doesn't go higher than this level. And we have a name for this level as well. We already said it. It's called a resistance level. So we have a vertical resistance level. It is very powerful. The bulls are trying to get the market to go up, but the bears are also resisting. At the end, it turns out that the bulls are winning and the market breaks up above the resistance level. This makes a ascending triangle. And then we have a descending triangle, where this time the support level is vertical. Keep in mind that you can also call this a support level and also this a support level, even though they're not vertical. But here, in a descending triangle, the support level is a lot more visible because it is vertical, and therefore it is also more powerful. It's more strong because so many times the pair or any market that you're trading is trying to break below it, but it can't. But guess what? When it does, as they say, what it doesn't kill you gets you stronger. The market, it shows that the bears are very, very strong over here, and you can see a lot of drops coming up after confirmation of a break below a descending triangle. Let me explain myself a little bit more. A symmetrical triangle, if you couldn't picture it, looks a lot like a piece of pizza. Fans of pizza? Yes, I love pizza. New York pizza is the best. Sorry, Italians in the house. So a symmetrical triangle looks a lot like a pizza pie, but it also has very important characteristics. One of the main important things that you want to keep in mind about a symmetrical triangle is that it is best and most powerful of an indication when the market, of a continuation indication, when the market breaks in the same direction of the previous trend. So let's say this market was trending down. We were on a downtrend. Then the market got trapped in a symmetrical triangle. If the market breaks somewhere between a half or 2/3 from the tip of the triangle, that is a very strong indication of a continuation pattern. Are you with me? Any questions yet? All right. So basically the market is going up and down, up and down, up and down, and then you get a confirmation. How do you understand the confirmation? I know that I've been repeating this. Confirmation, confirmation. What do I mean exactly by it? This is what I mean. Now you have a better idea. We have that zigzags now in candlestick patterns. It is a little bit different than the line chart that I showed before, but still you can see the triangle over here, right? So these are our candlesticks. We have a fair bit of bearish sentiment and a downtrend over here. And then suddenly the market is zigzagging sideways. And as a technical analyst, what I do is that I draw a line connecting all the highs, and I draw another line connecting all the lows, and I notice that, oh wow, they actually reached each other at this point and made a symmetrical triangle. So I probably drew this symmetrical triangle, let's say around here. And I'm still not sure that the market, where the market is going to go after this. Then I see this candle. Then I see this candle. What is this candle? We covered this last week. This is a spinning top. This makes a market indecisiveness indication. And then soon after that, I had a bearish engulfing candlestick pattern. You see? A strong bearish market, a candlestick right after a spinning top. And it is breaking out of the symmetrical triangle right in the middle of a 2/3 of the triangle from the tip. So right around here, when the second candlestick starts below the symmetrical triangle, this is where I want you to take a note. The confirmation comes when the second candlestick, after a test of a breakout, opens below the symmetrical triangle on a downtrend. This is my indication of confirmation of continuation pattern. So here I know that the market is going to go down. So once I see this, I basically backing it up with other forms of analysis. Of course, they were only talking about continuation patterns, but definitely you have to be aware of the market news, be aware of other technical analysis as well. But let's say you've checked with everything else, everything is giving you a thumb up, and this is where I enter a bearish position. I open my bearish position around here, and I set my stop limit somewhere around here. The reason why for that is, number one, I don't want to be greedy. And number two, it is often proved that the market, even if it's a continuation pattern, moves down the same length of the opening of the symmetrical triangle. So how many pips are there between point A and point B? You calculate this and you bring it up down to here, that same amount, and you get out of the market, you set to get out of the market around there. Yes, of course, sometimes the market moves even lower, but more often than not, you can risk the market actually retracing and going back up, and with you not having gotten out of the market, would lose money. So that's what we want to avoid. Once again, let's repeat the symmetrical triangle because it's the most important of all, and the rest basically are pretty repetitive. So again, here we were on a downtrend. This can also happen in an uptrend, of course, but well, our examples today happen to be downtrends. So we were on a downtrend until the market or the currency pair or whatever you're trading reach point A and goes back up. And then it goes back down to point C, and then goes back up to point D. And as you're getting closer to the tip, I mean, by here you can already identify the triangle, right? And then as you get closer to the tip, this vibration is getting lower and smaller, and the trading volume is going lower. And this is when you know that this is the calm or the storm. You wait for the confirmation. You see the spinning top of indecisiveness, and then you see the next one over here. So around here in this market, this could have been my or your confirmation of the breakout, and you would get into that trade around this price, set your take profit to around here, which is the same amount of the distance between points A to B, get out of the market, and enjoy your pips. Next, we have the right angle triangles. We talked about them, the ascending triangle and the descending triangle. If you had problems envisioning it, I came up with the perfect metaphor, which everybody likes, I hope, and that is a cake. So the dessert after the pizza. So an ascending triangle, as we said before, it has a vertical resistance, as you can see over here, just like this cake, and it has an ascending support level. Descending triangle, on the other hand, has a descending resistance and a vertical support. So let's see how we can use them in our trading. Hannah, we have our ascending cake right over here within this chart. How delicious does this look? So this time we have an uptrend example. The market is in an uptrend, a fair bit of bullish candlestick patterns until it reaches this level at 1.0. I bet this is dollar CAD. And then it goes down, and then it goes up again to this exact level. Then it tries to go down again. It can't. It goes up again to this exact level. So now already I know that this is a very important and strong resistance level. If you have been attending our previous webinars of candlestick chart patterns, we could have thought that this could turn into a triple top. But that is why we have to pay close attention to this level and wait for a confirmation, because if we don't see the confirmation, as I said, this could have easily been a triple top pattern, which is actually a reversal pattern. So after that, instead of seeing the market going up, we could have seen the market going down. That is why I always wait for a confirmation. The confirmation here was pretty fierce. Look at this. The bulls are fighting up, then the bears are hammering them down, then the bulls are fighting up again. So here, we still don't have the confirmation, because the bulls and the bears are fighting. There is no open market above this key resistance level. Now, where did the confirmation come in this market? Of course, after we had a market open above the resistance level here. So I know that by waiting, I missed out on some pips. Instead of getting to the market at exactly 1.0, I got into the market at 1.002, but at least I was confident that the market is going to go up, that the uptrend is going to continue, that this is in fact an ascending triangle as a continuation pattern. Okay? So another thing you need to remember about an ascending triangle is that it normally forms during an uptrend. In comparison to the descending triangle, which normally forms during a downtrend. And well, as I said before, we called this area over here the calm before the storm of a very massive bullish uptrend, and that is the metaphor for it. The volatility normally goes down at the tip because the bulls and the bears have equal strength. We have less market participants, everybody's getting bored, there is no direct trend, and that could be another confirmation signal for you to know that a breakout is going to happen at some point. But still, we wouldn't know which way until we get the confirmation. So the volatility goes down, that is a confirmation that, okay, this is a continuation pattern, this is a consolidation. But it does not give you the direction of the market until you get the confirmation. Okay? Keep that in mind. I'm sorry, my throat is getting a little bit sore with all the snow that has been going on over here. Okay, so another thing that I wanted to point out about ascending triangles is that after the market breaks above the resistance level, this remains a key level, but it is no longer a resistance level because the market is already above it. So now this becomes a support level for future price actions. So you get on this uptrend, you make your pips up until 1.02, and then you can use this level as your support level or as stop loss order, basically, because the market may come down to this exact level because it has tested it over and over before. Next, we have the descending triangle, which is a bearish formation during a downtrend. Okay, this time as we have the support level, which is vertical, right? We have lower volume as we get closer to the tip. We have the zigzags. This is not as much of a zigzag as before, but it's still a consolidation. It's not as bearish as it was before. And the reason why it is a better bearish formation and a better signal for a bearish continuation is because you can already see that the bears are stronger than the bulls, and they're trying to hammer the zigzags down as they move forward, right? The bulls are trying to be strong and not letting the market go up and go further down, but the bears are just hammering it down, 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 down until you get the breakout. So look at this. This is an interesting, very interesting example. Even though we got the confirmation over here, so I would have gotten to this market at this level. The market did go up, back up a little, and then went back down. So that is why you sometimes also have to be brave and not get chickened out when you see that the market is going against you. If you saw the confirmation, if you backed it up with other technical analysis, don't back down. Do set your stop loss order at some level around here, right? But don't chicken out. Wait for the market. Sometimes you can get a correction. But again, as we said before, we want to set our take profit at the same distance of the the distance between the opening of the triangle. Next on tap, we have the rectangles, which are the king of consolidation. They happen a lot. And what happens is that the markets, the birds and the bulls, are hammering back up and down to the same exact level. Here, and they go here, and they go here, and they go. This is actually not the best example. I should change this one. But they're very similar to triangles in the sense that you have to wait for a confirmation and for a breakout. And again, you want to set your stop loss at the support level if it's in an uptrend, and you are in if you find the confirmation into the uptrend, if you get into the market, you want to set your stop loss at the support level. You want to set your take profit the same distance of the distance between the consolidation, this much almost. So you would want to get out of the market around here. Okay, exactly the same as the triangles. So rectangles, obviously, they can both be continuation or a reversal indication. And the only way you can tell it is to wait. Wait for a confirmation. And as you can see, this is an example of a rectangle during an uptrend, a downtrend, which actually acted. But again, when you see the breakout, when you see the confirmation of the breakout, again, you have to make sure to create your take profit order the same distance as you have within the zigzags or the rectangle, right? Around here. So we're going back to reversal patterns as well. They happen. They're very, very similar, very tricky. All you have to do is wait to back up with other fundamentals and other technical analysis. Wedges. The metaphor I could come up with was not so hard, actually. It was wedges, the women wedges that they wear in the summer. So again, it is a pause during a current trend. We have two types of wedges, a rising wedge and a falling wedge. They're very similar to triangles, and they could both be a reversal or a continuation pattern. So how do you tell the difference between a wedge and a triangle? Very easily. In a wedge, both lines are either falling or rising. So in a falling wedge, as you can see, you have two lines. They are both falling, but from different angles. In a triangle, however, you have a falling line and a rising line. Therefore, these two lines actually meet. Falling wedge, if you continue drawing it, of course, they can meet as well, but nobody is going to wait that long, and the basic important thing that you have to remember about it is that both lines are falling. Falling wedge, both lines are rising for a rising wedge. So let's cover the falling wedge that can be both either a continuation or reversal pattern. But the good thing about the falling wedge is that the outcome is normally the same. After a falling wedge, regardless of the previous trend, you can expect an uptrend. So if you have a falling wedge formation during an uptrend, then you can expect the market to go through the falling wedge factory, get into an uptrend, and go up. Similarly, if you see a formation of a falling wedge during a downtrend, the market goes through the factory, zigzag, 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 but the outcome again is uptrend. That is a really tricky trick that I had to actually do a lot of studying to come up with and find out about. So there you have it in only 2 seconds. So the result of the falling wedge is upside movement. Let's see falling wedge in action on a candlestick chart. You have the uptrend over here. You have the pause. You connect the lines and you notice that it's not a triangle, it's not a rectangle, but it's a wedge. So therefore you wait for a confirmation. You already see the bullish formation coming over here. You see this candlestick also over here. I would get into the market around here after the confirmation. I would zoom out into different time frames, into a more micro time frames to see the sentiment of the market. And then I would get into the trend. I would set my take profit the same distance of the open area of the beginning of the wedge. Same as triangles, same as rectangles. I will take my profit out over here and I will enjoy my pips. Don't be greedy. The markets a lot of times go even lower, or continue even higher or during that direction, but sometimes they don't, and it's better to be safe than sorry, right? Same here in the falling wedge in a downtrend. As we said, the falling wedge is an uptrend making factory. So we are in a downtrend. We identify the falling wedge, and all we can expect is an uptrend. The uptrend reverses, and we get into the reversal market and make pips in an uptrend. So, to sum it up, we already covered it, but this one is for you to take notes. How to trade a falling wedge. You place an entry order to buy the currency pair above the upper line of the falling wedge, around here as we said. You set a take profit limit order to close the position at the price in which the pair has moved up to the same amount at the height of the beginning of the formation. That here. So this is the amount you get out of the market. One thing I haven't mentioned here is that you also set your stop loss order at this support level, which is the lower line of the wedge, so that you don't lose more than you can afford. Responsible action towards your trade. Finally, we have the rising wedge, which is the opposite of the falling wedge. It reverses, or it basically is a downtrend factory. It changes a downtrend into a downtrend, and it also changes an uptrend into a downtrend. But you also have to, again, wait for the confirmation before making any hasty decisions. So it interrupts a downtrend. It makes the zigzags. You wait for the confirmation around here, get into a downtrend. If it forms during an uptrend, it makes the zigzags. You wait for the confirmation, and you again make money during the downtrend. So how to trade the rising wedge now? Similar steps as the falling wedge. You first confirm the pattern. Wait for the confirmation of the break. You are aware of a false break, which is when the market actually merely tees the support level over here, but doesn't quite open below the support level. That is a false break. Be aware of them. You place an entry order to sell the price right below the lower line of the wedge. So you enter a bearish trade, and you close the position at the price where the pair has moved down the same amount as the height of the beginning of the formation. That's it. Very easy. Do we have any questions? I actually haven't even looked at the chat box. My bad. I can see it today. Unfortunately, I can't. Okay. It seems I can't see the chat box today, but obviously, if you have had questions. If you had written down questions and I haven't responded or I haven't seen, please do send your questions afterwards to info@orbex.com. Okay, so I'm not seeing the questions. I'm assuming everybody is okay. Let's do the summary of our webinar today. We talked about continuation patterns. We talked about the 3 most important continuation patterns, which are, as a group, triangles, rectangles, and wedges. This is not a kindergarten math class. This is a forex trading class, but the patterns have these funny names. And the symmetrical triangles also are divided into, the triangles are divided to symmetrical, ascending, and descending triangles. The symmetrical triangle looks like a pie of pizza. It is the most reliable when the market breaks out somewhere between 1/2 and 2/3 from the tip of the triangle. And ascending triangle normally occurs during an uptrend. A descending triangle normally occurs during a downtrend. Rectangles happen a lot, and they're very tricky because you can never tell if they're going to be continuation or resistance. All you have to do, and the only thing you have to do, and you can do, is to wait for a confirmation of a real breakout. Then we have a falling wedge, which is an uptrend factory. And then we have a rising wedge, which is a downtrend factory. No matter, regardless of the previous trend before the falling or the rising wedge, the market normally reacts the same way. So these are what we had for you today for continuation patterns. I did promise to make a live market walkthrough because we did have something interesting happening. But before we go there, I did want to talk about Women's Day on March 8th. We are promoting and empowering all women to invest. Orbex itself has been doing a great job on the campaign. We're using the hashtag #InvestLikeHer. If you are a female trader, or if you know of a lady, your mother, your sister, your friend, your colleague, your fiance, your wife, anybody who is interested in the markets and any kind of trading or has a success story about trading, please share your stories on social media. Use the hashtag #InvestLikeHer. Share the success stories, and it's going to be great. Hopefully, we're going to get more female traders in the market. They are awesome. They actually do make better trading decisions than men. I'm not making this up, believe me. Okay, so now I want to do a quick, live market through. I've been disconnected. Hold on one second. I have disconnected from my chart, so allow me 1 second.